You thought the Roth was important before, it's even more important after the new tax laws. I'm going to explain 4 reasons why and what you should do about it. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There is a clear trend with the new tax laws. Very clear trend that started actually not with just these tax laws, but the plethora of new tax law changes that we've had over the past few years. And that is new tax benefits, new tax deductions or credits are being introduced. But if your income's above certain thresholds, then they start going away. There's income phase outs. And this isn't a new thing, but it's a very, very clear trend. Here's a new tax benefit, but if your income's above certain thresholds, you don't get it, or you start losing it, or you lose a portion of it, or you lose all of it. It's very, very clear. Managing your income, your modified adjusted gross income, used to be important, and it's even more important right now. And I would expect that this trend is going to continue. Now, you might say, rightfully so. Rightfully so, that's how it should work. Tax benefits should be there, and if your income's too high, then you lose those tax benefits. And yet, some of these income thresholds, some of those, they're called phase out, some of those income limits don't change. So even if you say rightfully so today, each year that goes on, if that limit is staying the same, and we all know inflation is causing income to go higher and so on, there's more dollars out there, it means fewer and fewer people are able to get these tax benefits. Take, for example, the tax on Social Security. The tax on Social Security was introduced in the 80s and 90s, and it said, well, if your income's below certain levels, then your Social Security is not taxed. But as soon as your income, a certain formula, goes above certain levels, some of your Social Security starts becoming taxable. Those levels haven't changed since they introduced them 30, 40 years. Those levels haven't changed. That means Social Security is becoming taxable for more and more people every single year. What about college tax credits? The American Opportunity Tax Credit, that was introduced in 2009. Okay, there's a lot more dollars floating around in the world these days in 2025 compared to 2009. Yet those phase outs, those income levels that were introduced back in 2009, they haven't changed. It's the same. Therefore, managing how much income you recognize on your tax return while going out there and trying to be as financially secure as possible, looking for ways to manage your income and what lands as modified adjusted gross income is critically important. Therefore, you thought the Roth was important before, having more and more of your wealth, your hard-earned savings saved up into a Roth IRA, Roth 401k, an account that's going to grow tax sheltered and tax free for your financial future is even more important than it used to be. And guys, it's even harder to get money into because now there's less incentive. If you're going to qualify or could qualify for some of these new benefits, the new tax deduction on qualified tips or qualified overtime, well, if your income is near those limits, you might want to contribute pre-tax instead of Roth so that you get that deduction and you ensure that you get that benefit. Same thing with the new senior deduction. There's an income threshold, $150,000 of modified adjusted gross income, married filing jointly, half that for single filers. You might have wanted to do Roth conversions, getting more of your dollars in a Roth, and you might say, nah, I'm not going to do that anymore because it would limit my ability to get this new tax benefit. So having your dollars, your wealth grow in a tax-free account is even more important. And there's new disincentives that could be at work to help to prevent you from doing that. So why is it so important? Why is it so critically important, becoming more important to have dollars in the Roth? I've got 4 reasons, and the first one's the obvious one. Withdrawals from the Roth IRA, Roth 401k, as long as you're age 59 and a half and you've had the account for 5 years, it's a qualified withdrawal. It's not taxable to you. It doesn't play into the equation for what is your modified adjusted gross income, and therefore is your Social Security going to be taxed? Are you going to get the new senior deduction? If you're still working and drawing dollars out of a Roth IRA or retirement accounts for whatever reason, maybe working part-time and receiving tips, it's not going to count against you in that calculation for modified adjusted gross income for tips. Not going to count against you for the calculation of IRMA, income related monthly adjustment amount, where you pay the surcharge. Withdrawals from your Roth IRA or Roth 401k, qualified withdrawals, are not taxable and therefore aren't a part of the equation for this modified adjusted gross income, and therefore won't kick you out of receiving some of these tax benefits. So that's the obvious one. But the second reason is becoming more and more clear as well, and that is the capital gains, the interest, the dividends generated from a Roth account, from the Roth IRA, Roth 401k. Those are sheltered from tax. Those are sheltered from tax. And right now, in the wake of higher interest being paid out on your savings accounts and money markets, you've got interest, you've got taxable income that's landing on your tax return that is pushing you closer and closer to these barriers, these income phase outs, that is jeopardizing those tax benefits for you. The dollars that you have in the Roth, and by the way, any tax shelter, but again, another benefit of the Roth, it's not landing on your tax return. So say you own an investment and you want to start getting some liquidity, or maybe you want to get out of that investment and trade and get into something else. By selling that investment within the Roth IRA, it's sheltered. That capital gain does not land on your tax return. You can sell that investment, reinvest it into something else, and not have to worry about your income going up and losing some of these new tax benefits. If, however, you held that money in a Robinhood account, or you held it in an individual account or a joint account or a trust account, and you wanted to sell an investment to use the money, or sell an investment to invest in something else, the capital gains are going to land on your tax return, whether you take possession of that money or not, and it's going to limit your ability to receive these tax benefits because it'll push your modified adjusted gross income up. Second clear benefit, why the Roth is even more important today than it was previously, is tax sheltered dividends, capital gains, and interest. Third, now we're back to benefits specific to the Roth. Third reason why it's even more important right now, because of these new tax laws and the ongoing trend of income phase out for tax benefits, no required minimum distribution. That's right. There's no time at which you're forced to start drawing money out of your Roth. And by the way, even if you did, it wouldn't impact the calculation. But I was just working with an individual where they're in retirement. Okay, he's working part-time, but he's in retirement. And we did the math, and because of the different income sources that they have, they're going to be really close to this new senior deduction, really close to that $150,000. But their RMD starts in a couple years. And as soon as their RMD starts, no way. Their income far surpasses the threshold, and they're going to start getting phased out in a very meaningful way from this new tax benefit. With a Roth IRA, more of their wealth, had it been in the Roth IRA, and by the way, that's been a strategy for the past 10 years that we've been working with them on. How can we build up that Roth? They came to us without a Roth. Now they've got a couple $100,000 combined in there in the Roth, but still, large amount of their wealth is in pre-tax. It's going to have a required minimum distribution that's going to land on their tax return and raise their modified adjusted gross income and limit these tax benefits. So Roth IRA, Roth 401k, no required minimum distribution, no time at which you're forced to have this money land on your tax return and ruin your ability to get some of these benefits. And then the fourth reason, the final reason why the Roth is even more important in light of this new trend and these new tax laws, it's inherited tax-free by your beneficiaries as well. Roth 401ks, Roth IRAs are inherited tax-free by your beneficiaries as well. Think about it. If you're thinking about this and saying you're building up wealth and all of that, well, how many folks that are near retirement are receiving overtime or getting tips? Yeah, maybe not many. If you're driving for Uber or Lyft, maybe some. If you're working part-time or whatever, maybe some, but not many. What about if your kids inherited these dollars? You passed away and they inherited them. They're now subject to the 10-year rule. They've got to withdraw those dollars, your retirement dollars, within 10 years. And if you've already passed your required beginning date, they've got to withdraw some each and every year. And if they are receiving overtime, if they are in a tip-paying job, if they are near some of these financial thresholds, and all of a sudden by receiving that inheritance from you and being forced to liquidate and withdraw those dollars, that adds to their modified adjusted gross income, that could easily push them over the threshold to lose out on some of these benefits. With a Roth IRA that they inherit, or a Roth 401k that your beneficiaries inherit, your kids inherit, that is still subject to the 10-year rule, but every time they make a withdrawal, it's not taxable. And it's not calculating, it's not part of that calculation to determine the phase out in for modified adjusted gross income. So another more important reason for the Roth IRA. So the question begs, what makes the most sense for your situation? Should you be contributing pre-tax or Roth? Should you also be doing Roth conversions? Should you consider backdoor Roths? Should you consider mega backdoor Roths? These are financial strategies, and while they make a ton of sense for a lot of people, it's not one size fits all. You've got to work with your certified financial planner, see what makes the most sense for your situation right now. That situation could change next year. It could change in 2 years, but it's even more important that you're having that conversation, doing that proactive planning so that you can get as much money of your wealth growing in Roth accounts so that it doesn't count towards these phase outs that are inevitable, that are more and more to come, and certainly have been more in the past few years. So work with your certified financial planner on that. If you don't have a CFP on your team that's doing tax planning and helping with all 6 areas of your financial life, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.